Good Tuesday morning, Market Chameleons. Everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please look at the share to screen and the disclaimer. Be aware that neither Market Chameleon, myself, or Dimitri are registered investment advisors or broker dealers. If you are searching for investment advice, please seek out a registered representative. This show is for informational purposes only concerning Market Chameleon tools and features. With that, D, look one last time at the disclaimer, everyone. Here we go. What's going on this morning?
Good morning, everyone. And let me share my screen. Also, a note to anyone joining us for the first time. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it, and he'll let me know, read it back to me. And to give you guys a couple minutes to put those questions in, we're going to start out taking a look at our pre-market report, see if we could get insights, what's going on in pre-market hours, and then we'll move on to our questions. So over here, we are on the pre-market report, and up top, you'll see this calendar view, which displays a summary of what happened in a pre-market in the last week. And this allows you to look at the most current date and compare that to what's been happening recently. Also, you could really quickly scan and see if you eyeball any type of trends or anything unusual. And if you click on that date, it will give you more details what happened in a pre-market on that historical date. So let's take a look at today's, April 16th. We see 341 stocks so far trading higher in pre-market, 491 stocks trading lower. We have 139 million shares trading on up volume, 72 million shares trading on down volume. And if we convert that volume to dollar value, we have $3.5 billion worth of stock trading higher, $1.7 billion worth of stock trading lower. So from this perspective, it's a little bit of a mixed bag. Certainly more stocks. The number of stocks trading down exceeds the number of stocks trading up. The dollar value of the stocks trading higher exceeds the dollar value of the stocks trading lower. There's no strong indicator either way. Let's take a look at it from a couple more perspectives before we move on to our questions. And now I'm going to scroll down, and you will see a more granular view of what's going on in pre-market. We have a list of stock symbols with price changes and volume, alerts. And here we have a list of our most active stocks in pre-market, our biggest percentage gainers and biggest percentage decliners. There are 46 stocks that made it onto our percentage gainers list, 89 on our biggest percentage decliners list. So that indicates that there is a more bearish lean or bearish sentiment in the pre-market trading. Now, to make it onto this list, we have certain thresholds because stocks in pre-market tend to trade with less volume, less liquidity. So we do set thresholds in place. And if it meets those thresholds, it can make it onto this list. But that does include stocks that are small cap stocks, ETFs, could be a leveraged product, could be an inverse product. So to narrow down this group, we could use the filters above. Up here, if you have a watch list, you can filter by your watch list. If you created a group of stocks that you like to track, you can filter this report to focus just on those symbols. We're going to use this filter here, the ETF filter. So when I click on it, what this does is gives us different ETFs to select from. And I'm going to choose this one, SPY. And what happens is it filters out the symbol stocks that are holdings in the SPY. Okay, these are filtered by holdings in the ETF. And By doing that, what we did was now narrow down our report to stocks that belong to the S&P 500, because that's what the SPY is. That tracks the S&P 500 stocks. And here we see that 11 stocks made it onto our percentage gainers list, 7 on our decliners. And now this points a little bit more positive lean in pre-market trading. So right now, I think that it's just a mixed bag. Nothing that really we could latch on to saying that there's overwhelmingly a positive sentiment or negative sentiment in pre-market. Depending on which way you look at it, you'll get a little bit of a different indication. Well, we did give it a couple minutes, so I will take questions if you have them now.
No new questions popped up this morning, but Rob is on and he asked something about the price distribution report yesterday, if that was something you could go over.
Yeah. Okay. So let me go over that tool, but let me kind of set it up first just to give it an idea what use cases you would use this tool, and then we'll go to the tool. So when we look at analytics for options or even stock analytics, stock behavior, let me just come out here. Let's start with the options. When we're trying to analyze, an option, right? Let's say here's an option that we know that it has certain days to expiration, right? Like this has 2 days before it expires. So we know that up front, right? We know that that's information that we have certainty. We know exactly when an option expires. We also, when we look at an option, we know the strike. So if we know the strike of the option, 510, and we know where the stock price is, 504, we know what the stock needs to do between now and then, right? It needs to cover that percentage move to go into money. So, and then we see what the market prices are of that option. And so we have like all this information that we know that it's certain, and then we have a bunch of then we have to try to come up with a value for an option which is uncertain. What we don't know is what the stock is going to actually do between now and 2 days from now when it expires, right? Because if we knew that, then everything would be easy, right? Then we would trade with complete certainty. We couldn't even call these actually like risk assets or risk premiums, because everybody knows, like a CD, everybody knows that you're going to get 5% or whatever it is that you sign up for, at maturity, or treasury, what you're going to get at maturity. Here, we don't know. It could be 0, it could be any amount. So then when we look at the market, well, what do you want to do is, as a trader, what are you trying to do is figure out, well, I know the risk, right? Because if I'm buying this, well, then I do know the risk, I risk losing that premium that I buy. If you sell it, you don't really know your risk because it could be unlimited, but you know your potential reward. So on one side, when you sell it, you know your potential reward, you don't know your risk. If you buy it, right, you know your risk, but you're not sure about your potential reward. It can be unlimited. So what we do is then we start asking questions. Well, what do we think this option should be worth? Where do we think approximately should it be worth reasonably? And based on that, in the long term, what would be our expected return from from that option. So, valuation models become key when you're trading, right? Those are your benchmarks to kind of see where the market is relative to where would it be potentially valued, a theoretical value. And if we don't know with certainty where the stock will be, or if we don't have information to give us a good value, if it's not a takeover or whatever, if we don't know that information, what we could do is start looking at how does this stock move historically, and based on that, just based on historical movements, where do we think this option should be priced around, right? We need an estimate. So we don't know exactly where it's going to be priced. We don't have an exact value, but we need an estimate, right? And that's where that return distribution comes in. So think of it as like, if you're trying to estimate what is the, what will be the score of this football game, is it going to be 5 or 10 or 20 or 30? Well, if you don't know, you start looking at the historicals. Well, what is usually, a team like this score? What is the high range? What is the low range? What is the middle range? What is that's what you're going to start doing, right? Looking at the distribution of historicals to try to get an idea to narrow down that range to see what are likely scenarios. So that's where this tool starts coming in to play. So let's go over here to price action analysis tool. Right. And here we have it for here, I'll put it on for SPY here. And maybe our question is the following, when before I moved on, I should have looked like whatever it was, like maybe 1% away or 2%. But let's take a look at what SPY, usually does in over a 2-day period, right? So I'm going to use 2-day period to see historically, how does SPY perform, over 2 days. We could do it over 3 days, over 4 days. Obviously, the longer you go, the more movement it could have, right? It could move much more over 4 days, 5 days than it can in 2 days. So we'll set it at 2 days. And then we could decide how many years do we want to look at, so we could change this around too. It's defaulted to 4. We could do it to 5, to 2, we could do it shorter term, longer term, but let's keep it at 4 years for now, initially. And then we're going to run our analytics and see what happened, right? So I'm going to go here, get results. And now we see that if we took a long, 4-year period, and over 2 days, now we get these stats to help us out to understand how SPY usually moves. So it tends to go up, and we have been having like a bull market. So here over 2-day period so far, almost 60% of the time, the stock was higher, 40% of the time, or 41% of the time it was lower, 59% of the time it was higher. So you could see that, it goes up 1.4 times as many times it goes down. What about the average move? Well, we take the average move because there could be a skew in there. So, in other words, if it's up 60% of the time and it's down 40% of the time, well, it's not always up exactly the same amount that it's down, right? It's not like it's always up 1% and down 1%. It's not like a coin flip. The up moves could range and you were above zero to infinity, and the down moves, and you were below zero to where the stock goes out of business. So if we averaged out all the moves, right, just to average out all the moves, if we get a negative number, well, what would that imply? Well, that would imply that when it goes down by a much bigger magnitude, because we have more frequency of up moves than down moves. So here we see that on average, the moves were positive 0.14%. What about the median move, right? Because the average either way could get skewed, because you could have, a couple really big outliers, right, to the upside that skews it up. So the median move is like right in the middle. If we divided all the moves, look right in the middle. So that's 0.23%. So just looking at these two numbers, right? If the middle move is 0.23%, the average move is a little bit lower, 0.414%. There is a little bit, of a skew, perhaps to the downside, maybe a couple more tails to the downside that pulled that average down. So that's what this is looking at, more comparing median to average. So what about just splitting it up? Let's split it up, positive moves and negative moves. So if we took just the positive moves, right, and said, well, if we experience an up move, what does it do on average when it's up? And if we experience a down move, what does it do on average when it's down? Let's compare those two. So here, these are the average of all the up moves, 1.14%. This is the average of all the down moves, negative 1.27%, which is indicating, right, that the down moves, when it was down, it tended to go down by slightly greater magnitude, right? Even though it was down less times, it wasn't, we're not talking about equal amount of time, but if we took all these 41% observations and averaged out those negative moves, they averaged to negative 1.27. So the stock, when it goes down, it experienced a little bit of a bigger decline on average than when it goes up, which kind of makes sense, right? That's just how things, tend to work in the market. Things go down a little bit faster, and by greater magnitude, and it's more orderly as we go up. So then let's take the high-low range. Well, what's the best move and worst move over 2 days? All right. So the best move in the last 4 years, up 6.5%. The worst move, down 6.6%. So what we're doing here is now just mapping out and building ourselves a visual historically of potential outcomes, right? By looking at ranges, right? The ranges, the high, low, the averages, the tendencies, the separation of ups and down moves. And here we have, so we're getting better ideas of, how this moves, and, potentially reaching any type of, strikes or whatever, because you got, even your high and low ranges. So this here is a distribution of positives versus negatives, right? This is a histogram. So you could see how it's distributed and the tails, how often the tails hit. And then we could come down here and then look at the frequency of moves that go beyond a certain percentage away. So now we have negative moves here, positive moves here. So we could see here that positive moves were 58.5%, negative moves 41.6%. So these are the observed 416, 588. What if we wanted to look at a 2% move, right, over a 2-day period? Well, to go above 2% over here, we see that happen 9.8% of the time historically. 98 observations, 9.8% of the time. Stock went up above 2%. What about 4%? We could see that's even harder. Point that happened less than 1%. And then you could see here it's declining. Same thing to the downside. Well, what about down 2%? Well, that happened 8.7% of the time. So it wasn't as frequent. See, the moves above 2% were more frequent than the moves down 2%. Keep in mind that it's not looking at magnitude, just the frequency of the moves. 4%, you could see that happened a little bit more often, right? So when we get to those tails, right, to the really long 4% moves, now we see that the downside, which means that, once the magnitude really far out, the tails that happen a little bit more frequently than the tails to the upside. Okay, so you can see here a move down 4.5% or more, that happened twice as many times as a move up 4.5% or more. So we had 3 observations over 4.5%, 6 observations down 4.5%. So that's why we see a downside skew, right? That once it really accelerates, it could the bids could get removed quicker. That's that part of it. This also then kind of summarized what we just looked at: 59% to the upside, negative 41%. This is the average of the ups, average of the downs, average of both, the median of the ups, the median of the downs, right? So you could see here that the median 93, so the average is pulling it up. Here, the average is pulling it down more. This is the absolute move to the up and down, so the absolute move of all. So this is saying that if we converted everything to positive, all of them to positive moves, how much does it just tend to move around, up or down? That's 1.19%. So these would equal here, but if we took all of them, you could see up or down 1.2% almost. Right, so that's the average 2-day move in either direction. So then we got the range to high low.
AD?
Yeah.
Rob asks, are the days always trading days, or are all days included when market is closed?
No, they're always trading days. So it has to be, that's a good question. Thank you. But it will only look at trading days. So if the market is closed like for a weekend or like a holiday, it won't include in that 2-day period a non-trading day. So it only looks at two trading days. It has to be 2 trading days. But yeah, thank you. That's a good question. And then in addition, we look at the standard deviation of the moves around the average. So the standard deviation just tells us, okay, if we had this average move, and this is, the part of the volatility is that if we have this average move, let's say of 1% to the upside, let's say every time it's to the upside, one on average 1.14%. Well, if it was exactly 1.14% every time it went up, right? If it was exactly 1.14% each time it went up, that would imply there's a 0 standard deviation. It doesn't vary, right? It's not like sometimes it's 0.5%, sometimes it's 2%. If it's exactly 1.14%, that means there's no variance and that means the standard deviation is 0. But we know that's not true, right? We know that's not true, but here we could even quantify, right? We could run a standard deviation of all the up moves around the average, and now we see it's 0.94%, which is significant, meaning that it could, it could be all over the place. It could be 2%, 0. So there you go. So it's a big standard deviation, right? So you have to take that into account, right? So when you're doing an estimate, if you're estimating anything, you could come up with a number. Usually come up with a number, an average, right? But what does that average mean? Well, the higher the standard deviation, the higher your range is, the harder it is to make that estimate, and the less certainty it is around that estimate. So this is what we're looking at here, that there's a big standard deviation to the upside and even to the downside, even a greater standard deviation to the downside. So this is the variance of the observations around the average. Okay, the variance of those returns around the average. So that's this table, which helps us understand the data, understand how the stock tends to move. How do we want to, plan and strategize around that? So let's keep coming down. And now this here is giving us the dates of the biggest negative moves and biggest positive moves, if we wanted to go back and just see like what happened there, or if they're close together. So sometimes you'll see the negatives and positives very close together, because you'll have volatility periods, right? So sometimes in big volatility periods, you might see positives and negatives moves very close together. So here we see the biggest, two. They both happened in 2022. This one was in June, big negative move. Keep in mind that, June 9th, June 13th, there could be weekends in there. So that's why we have to count it when there's 2 open days. November 9th to November 11th, we had a big positive move. Here, June, which June 9th to June 11th, 2020. So these were 2 years apart, negative 6.3%. June 8th to June 10th, down 5.5%. So these two were close together, right? These two. April 17th, April 4.7. And you could see here that a lot of these in the last 4 years happened either in 2022 or 2020, which, the 2020 was the around the COVID, right? Well, so you could go back and maybe look at, those situations and see how rare they were, but you could see what, let's you go back and analyze it further if you wanted to see those tail moves. But all right, Will, we're right up at 9:30, so I'm gonna stop here for today.
Hey, great job, D. Thanks for the question, Rob.
Thanks.
He says, thanks, D, for answering it. Awesome job as always.
Okay. And everyone stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, chameleons. Everyone have a great day. Thanks, D.